Good afternoon, ladies and gentlemen. Welcome to our special series of Market Masters. Our guest today is a special gentleman, Mr. Rakesh Arora. He's the co-founder of Go India Advisors for the last 7 years, which helps, this is a research house which helps little known and under-researched companies find their true wealth. And a decade previous to founding Go India, Mr. Arora was the head of research at one of the finest research houses, which is Mercury Capital. Mr. Arora is an engineer by qualification from IIT BHU and one of the finest stock pickers on Dalal Street. Rakesh ji, welcome to Market Masters. It is such a pleasure for Sakshi and me to host you on our show.
Thank you so much. Thank you for hosting me.
Chaliye, we'll start immediately with the outlook on the market. Given the developments, Rakeshji, that have happened over the weekend as far as the Middle East is concerned and the green tick that you see in crude oil prices, how would you look at sentiment on the Dalal Street on the broader level, and where do you think markets are headed over the next 3 to 6 months?
So, see, Indian markets have been a strong outperformer globally. And this year, over emerging markets, Indian markets are performing almost 800 basis point. So that's a big outperformance we have seen, if you compare a period of last 20 years, since 2020, Indian markets have been, at a tier. So this outperformance is most likely going to continue because India is one of the bright spots with GDP growth likely to be, around 7% CAGR, whereas the nearest competition like China would be struggling to reach even 5%. So India is truly the bright spot. And secondly, globally, people think that probably the Benton for a structural story is shifting from China to India. So that is also really helping. And Indian have done a lot of reforms like GST, etc. And everybody is off our, a digital system, whether it is, UPI, Aadhaar labeled, approval systems, etc. So global markets are looking at India as a long-term play. And so this is all good news, but the backdrop is not that encouraging because at the one end, developed market like US, Europe are struggling with inflation, and we are not yet sure whether the interest rates have peaked out. Meaning only over the weekend, or rather on Friday, we saw the employment data come out extremely strongly in US. So things are not moderating as fast as what US Fed would have liked. And that means that there could be higher for longer kind of high interest rates. And that would mean that, the downfall could be, deeper whenever it comes. So we're expecting that, recession could hit somewhere in 2024.
Okay.
Coming to, the geopolitical situation, uh,
Please go ahead, sir.
coming to geopolitical situation, basically, obviously there was Ukraine-Russia conflict which was going on, and now you have this Israel issue. While these are, kind of pocketed into the small zones, it doesn't really impact India much. But if crude oil starts to move up, then, that could be a big overhang. So, and also, let's not forget that we have a slew of elections coming up. So I would think that given the whole thing, India would continue to outperform, but there's a chance that there could be a little bit of time correction after the strong rally that we have seen, and markets can consolidate for a few months before they hit new highs from here on.
Right. Rakeshji, let's drill this down a little further. We've seen the US 10-year bond yield hit a 16-year high. The dollar index is at a 10-month high. Crude is coming back on the boil. Given the macro circumstances and the headwinds that Indian markets face, what could you think would be the immediate downside where, friends of yours from foreign shores, domestic investors on the institutional side, ultra HNIs would again open their pockets up and buy aggressively?
So we saw strong inflows till August. Only in September we have seen some outflows, and until unless situation deteriorates, further, I don't really see, um, foreign investors selling very aggressively Indian market. They are overweight India, but not so much. So until unless there's a risk of trade happening globally, I don't think there will be too much of selling in India. So having said that, I think Indian markets currently, if you look at valuation, they are around 8-9% higher than the long-term averages. So that is possibly the downside. But I would think it will be more likely to be a time correction. So I don't expect markets to go sustainably below 19,000 levels in the near term. There's strong earnings growth coming in. Consensus is penciling in around 20% earnings growth for current year and around 17-18% for the year after. So there's strong earnings momentum. And plus, since it's a pre-election year, government spending is also very strong. So overall, I won't really worry too much. On the downside, I think there's around 3-4% downside from current levels at the max.
Okay, 3-4% downside from the current level. So, if the markets were to correct these 3 to 4% as a strategy, what would you advise investors? Keep some powder dry right now, and if at all that correction comes in, where exactly would you advise them to buy?
So while I'm expecting market to consolidate and remain range bound between 19,000 and 20,000, there would be a lot of rotation among the sectors. So some sectors which have run up quite smartly and are trading at very high valuation, there could be rotation into underperforming sectors. So already we are seeing little bit of that happening. So we are seeing some pop coming up in pharma, chemical, and people moving out from some of the favored sectors. So sector rotation could be one of the things. And secondly, I think it will be a stock pickers market rather than a broad rally that we have seen till now. So people will have to do the work and find out, identify companies, and do some stock picking to really be able to outperform in this kind of environment.
Right. Rakeshji, your answer to Sakshi's question brings my next one into focus. Let's try and build a portfolio at current levels. We've seen, as you very rightly put out, that a very sharp outperformance on mid caps and small caps in India, as also the Nifty, when you compare it with other Asian peers, has happened over the last 18 odd months. Should you construct a portfolio, what are the sectors that you will look at, and what probably would be a couple of stocks that you would want to add at the blue chip or the mid cap or the small cap level?
So, the largest sector in the market is finance, which is around 30% plus weightage. And we have seen some of the blue chip companies actually underperform. So, whether it is HDFC Bank or Kotak Bank, etc. So, and these stocks are all trading at very reasonable valuation as compared to history. So, if you are building a portfolio, I think this should form the basic block for any model portfolio now. Number two is that there's been a big change in this sector with merger of HDFC Limited with HDFC Bank, and there's a big vacuum which has been created for funding of some of the real estate businesses. And here I think NBFC sector can really gain out of this merger, because HDFC Limited having gone out of the picture would be less aggressive, and there's a big opportunity for NBFCs to come and capture here. So I think some of the large leading NBFCs could be really added. NBFC has also not really done that, well, and they are trading at reasonable valuation. So I would say the big overweight should go to banking sector. Beyond that, we are expecting decent, government spending till the elections. And two sectors which really come to my mind are cement and infrastructure space, infrastructure companies. So I think some weightage has to be added to these two, sectors here, along with banks. The third is, there is a little bit of rotation, as I was mentioning. So some of the underperforming sectors pharma and chemicals, etc. One can selectively look to add, companies, as they are kind of bottoming out. So broadly speaking, I think these would be the three, four sectors that I would largely go overweight on, and restraining my, portfolio of momentum stocks to maybe 10-15% at max.
Okay. Mr. Arora, at this point, let's start off with our viewer question answers round as well. The first question that we've got for you is from Mumbai, and Adarsh Kumar has asked you this question. And, just to your point on banking and finance, the question is linked to that. He wants to know from you, what is the future outlook on NBFCs, and is it the right time to consider them over private banks right now? And why this question is also very important is because, off late we've been seeing a lot of move in Bajaj Finance, the poster boy of the NBFC space. And what that stock is really doing is something that we've already seen HDFC Bank do over the last entire decade. The sector was not doing well, but HDFC Bank was definitely doing well. Similarly, Bajaj Finance is really growing at a 30% rate. What would you suggest?
So I would say that, NBFCs, while there are two different categories, but NBFCs are slightly more preferred at this juncture, because banks we're expecting little bit of margin compression. Uh, their loan book was actually repriced along with the increase in interest rate, but the deposit is getting repriced now, and we are seeing a lot of aggressive posturing from HDFC Bank to really shore up their deposits. And only yesterday, BOB came out with numbers, and we saw that their CASA has dropped below 40% after a long time. So I would say that banks would see some NIM compression of 20-30 bips in the next few quarters. Whereas NBFCs, as I was mentioning, there's an opportunity to grow in a sector which was largely dominated by HDFC Limited. So that could, come as a, positive surprise for growth. And secondly, for PSU banks, NBFCs are really acting as a last mile connectivity, and we are seeing some, developments happening with a lot of NBFCs, looking at generating business for PSU banks in a co-lending model. So I would prefer NBFCs slightly better than private banks at this juncture.
Okay. Mr. Arora, one of the remarkable stories that have unfolded in front of us over the last 6 months has been the wonderful re-rating of PSU Banks, which for the last 15 years had practically gone nowhere. And this is backed by very, very clean balance sheets, falling GNPAs, falling NPAs, and of course the credit cycle on the upswing, which you've so wonderfully described so far. Has a fundamental shift occurred in the thought process of investors such as yours? Because earlier PSU banks were seen as trading bets, buy them at half-time books and sell them at 1.5, 1.8 time book. Is that dictum still holding true?
See, I would say that there's been a massive cleanup which has really happened, and the banks are also very selective these days in terms of. So I don't really expect that repeat of NPA cycle that we saw historically. So PSU banks should continue to do better as compared to what they've done historically. But have they peaked out? I'm not very sure, but they are very close to peaking out for the near term. But overall, their valuation should sustain at a much higher level than what you have seen in the last 2-3 cycles.
Okay. Would you say that the easy money in the second rung PSU banking counters has been made?
Yeah, I mean, at this juncture, I would be more happy looking at second rung private banks than look at PSU banks at these valuations.
Fair point you make as far as second rung PSU private sector banks are concerned. We've seen a very, very sharp rally in the likes of CSB Bank and Tamil Nadu Mercantile Bank. These are the ones that have been recently listed. Of course, Federal Bank has been one of the sharpest outperformers in the present rally. Be that as it may, you mentioned that the momentum part of this potential portfolio would be 10 to 15% of the overall money that we would deploy. Rakesh ji, I haven't seen the rally that we've experienced in defense counters over many, many years. Perhaps, somewhere in the dot-com bubble which was building up. This is what we saw about 20, 25 years ago, what we are now seeing in defense stocks. Is this sustainable? Do you think that the 5 or 6 defense companies that the government of India has have merit at current prices and valuations?
So, see, if you look at history, world was going through post the Cold War ended 2 decades back. There was a lot of peace dividend which came to global markets, and defense spending was at its low. I think it bottomed out in 2016 or 17. After the tussle between US and China started a little bit, and the Ukraine war was actually a kind of a catalyst, and you see defense spending going up across the world. Some of the countries in Europe who have never spent anything more than 0.5% of GDP on defense were trying to increase it to 1 to 2%. And now with the Israel conflict, I think the defense spending theme globally is going to gather more steam out there. Now, Indian government has been very supportive of Make in India, and these defense companies have been benefiting from the order inflow from domestic market. But I think there's a bigger opportunity to export also, given that global defense spending is going up. So I don't think we have kind of exhausted the upside on defense stocks. They might go through a consolidation, but I think this theme is going to last for a few years. So investors can look to add these stocks whenever there's a kind of dip in the market.
Okay. Let's take another question from our viewers, questions that we've got. And apart from all these buzzing spaces that you're discussing, defense, PSU banks, the other space that has come back to life is the IPO space. We've already seen 26,000 odd crore rupees worth of fundraise via the IPOs. So this question is related to IPOs. The question for you is from New Delhi. Shobha Patel is asking you this question. Is it a good idea to invest in IPOs for the short-term profit, or should one hold them for long-term?
So very difficult to make a journalistic comment, but generally, IPOs are well researched and well marketed, and companies give a lot of information. So you really need to look at, who are the investors in the anchor book who are coming in before deciding whether you should be investing in that stock or not, in that IPO or not. So I would say, take a stock-specific approach, meaning I'm seeing a lot of euphoria in SME exchange. In the main board, it is slightly less, and there are some good IPOs which are coming in. So a suggestion would be to look at anchor book, and if there are good mutual fund participation, probably those are the stocks which you should look to invest into.
The interesting part on the SME IPO index, Sakshi, is that it's tripled in a year.
Yes. Yes.
And I was at an event just yesterday in Mumbai over the weekend. You cannot imagine the frenzy that is there for quality SMEs which are performing very well. And some of the stocks, as Rakesh ji says, have really stretched valuations beyond limit.
Yep.
But this is the market, and as one of the most famous saying goes, भाव भगवान है, तो जब तक भाव है तो भगवान आपको दिखेगा ही. Shifting gears, Rakesh ji, let's analyze the infrastructure space in India across the country because of how the government has spent on infrastructure over the last 3-4 years. we have seen an immense amount of work happening on ports, roads, airports, other infrastructure which is related to waterways, railways. Across the board, there is a very, very sharp demand for quality products as well as quality infrastructure coming up. How do you look at the infra space given the capacity constraint that corporate India is now facing, because not many investments have been made over the last 10-15 years. So capacity is getting exhausted, but demand is still there.
So infrastructure space looks very promising because India is just a developing country, and whichever government comes in 2024, this agenda is not likely to go out of picture. And most of the Indian companies were earlier focused just on roads, and Bharatmala was the main driver for infra companies. But now there's another engine, which is railways, which have come in, and there's a big spending happening on railways. Urban infrastructure like metros, flyovers, so the opportunity size is kind of getting immense. In addition to the government spending, private capex cycle is also starting to pick up meaningfully, and this should also translate into orders for infra companies. So overall, I would say that from a growth perspective, infra companies have their hands full. There could be a little bit of lull which will come in, pre-election next year, because government will be more keen to complete the projects rather than come out with new announcements. So maybe that would be the time to really load up on these infra companies.
Okay. Mr. Arora, another question that's come in is from Mumbai. Seema Gautam wants to know from you, should one increase exposure to other alternate asset classes and amid this increasing geopolitical risks that we are seeing, like gold or dollar or real estate at this point? What would you say?
So my suggestion would be that one should always have a balanced approach. So the thumb rule is that 100 minus whatever is your age is the equity portfolio contribution that you should have. The remaining should be in debt and into maybe real estate and gold. So you need to follow that balanced approach so that whenever there's a sharp dip in the market, you can actually switch. So it should never be always 100% equity, but unless you are like people like us who day and night breathe on the equities. So for us, it's a much higher proportion. But somebody who is, and I would rather have retail investor leave investment in the hands of mutual funds. That's the safest and the best for them. And plus, it is highly tax efficient. So that's another part they need to consider.
Right. So do you really buy more when such geopolitical risks really happen? I think that would answer the question for them, because they are thinking of other alternate asset classes. Is this the time to actually buy more into equity?
Yeah, meaning and the valuations look attractive. The risk factors are actually less. So more the market falls, the more we are happy to invest. And that should be the approach people should take, meaning when things are looking cheap, you need to buy.
Right. Rakesh ji, you interact with a lot of deep pockets more than what we do. And over the last 10 odd months or a year, there has been notion building up in the Indian economy and its participants, as also in the markets, that this is probably the best decade that we have seen in a very, very long time as far as local macro good markets are concerned, and that better and happier days are ahead for investors because of a variety of reasons. Do you think that is true? Is it just a marketing spiel to explain why mid caps have doubled or tripled and small caps have gone up 10 times, and it's likely to collapse like a house of cards? Where do you stand in this equation?
No, so I firmly believe that we are currently going through one of the best patches, and maybe it will last for another decade or two. And see, the foundation for this was laid when GST was implemented. At the time when GST was implemented, there were a lot of global studies which suggest that when you do tax reforms like GST, the GDP growth can increase by 200 basis points. So this is what we are seeing. There's a formalization of economy which is happening, and that's where these small, and micro enterprises are, coming up. They are coming up in the formal channels. Earlier, they didn't have access to, probably funding. They were dependent on local, lenders, etc. But now funding is getting available to all these guys. The way penetration is happening, and suddenly they are able to grow much faster. So it's not that it's happened by accident. It is just by design that all the reforms that has been taken up is really helping formalization of the economy, and we are seeing more and more companies come up on our radar.
Okay, Mr. Arora, another very interesting question has come for you from our viewers, and this one also is from Mumbai. Tilak has wanted to ask you on the future of AI-based, internet-based companies, and is this the right time to invest in them, say over the next decade or so? We've been talking about, several pockets doing very, very well in the past decade, but going forward, and how do you compare them over the traditional tech companies? How should you advise them?
So for retail investor, I normally give a very simple explanation. Just look for companies that you're using in your day-to-day life. They are becoming an integral part. So those companies are definitely going to grow at the rate that they are doing right now, and are the best really investments in the new age, sector. So you don't really need to ask anyone. You just see what you're using in your daily life, whether it is ordering food or buying insurance or trading on stocks. So you just have to figure out what you are using and buy those stocks.
So if you're ordering food, that's Zomato. If you are trading online, that's Angel One. And what was the third one Rakesh ji said?
Insurance. So PV Tech, PV FinTech
so
is going
Policy
to be.
Bazaar. We've sort of made it simpler for you. It's difficult for Rakesh ji to talk about individual stocks because there are regulatory instances.
But he didn't talk about digital payments, huh? He didn't talk about
that's
that.
my next question. it's rare.
Need to add that on.
It's rare to get Rakesh ji in this kind of a talkative, chattive mood, and we will take the best advantage for our viewers because it's difficult to get Mr. Arora frequently on the show. Rakesh ji, what has also happened very quietly but very visibly is the advent of UPI. 10 billion transactions a month, which is somewhere like 4,000 a second. Can you beat that? And the event that I was yesterday in Mumbai, a very fine gentleman said that you are looking at 30 billion transactions a month in less than a year. Given that pace of growth and the financialization of assets that's happening, you've already put a very large chunk of the potential portfolio into finance and NBFC space. Who could be amongst the winners given this digital growth that we are seeing on the Lal Street, sir?
See, the winners are common man, because the ease of transaction has really helped the small businesses much more than the large businesses. Large businesses already had those systems, etc. But it's now the small businesses who are winning because of all this technology, and this really adds up because the informal small businesses account for 60-70% of the employment, and that generally is reflected in better consumption growth, better everything that we are seeing on the market and the economy.
So it's a benefit that the entire 138 crore people are enjoying. About 6-8 months ago, I met a very fine tech individual. He's a very well-known name in the tech space. And he said 5 years from now, there will be no money to change in your daily events that you do, buy coffee, buy a nimbu pani, buy a cup of tea, buy sabzi and all. And that seems to be, working out absolutely well. Now, forget 5 years. In about a year, it is becoming difficult to transact in physical money. So that's the underlying thing that has happened in the Indian economy for the betterment of, the broader economic space as well as companies as well. Rakesh ji, We've often, in the past 20 years, lamented the fact that agriculture, which is somewhere like 15-17% of Indian GDP, has not sort of contributed to economic growth and GDP as it should have, when it employs anywhere between 55 to 63% of Indian population. Given the circumstances that are there, do you see some stocks coming up as winners from that space?
Well, I think there's a big, improvement in the sugar space that we have seen, because government has been pushing up the usage of ethanol, and earlier this sector was, kind of captive to the vagaries of sugar prices and demand supply. But now they have another outlet, which is to sell ethanol, and so they can really change the mix to maximize profit. I think there's also another, well, sugarcane is highly water intensive crop. Because of the ethanol policy, there's a lot of investment happening in grain based ethanol, and that is also really going to help farmers in a very big way. First of all, now even the damaged crop can be utilized for making ethanol, so farmers who would have rather dumped some of the damaged crop can really, in fact, damaged grain prices have doubled in the last 6-8 months. So that all benefit is going to the agriculture space, and so see, all this will eventually lead to better GDP growth. Difficult to pinpoint companies, but from agriculture space, I think companies in ethanol space look to be much better placed for the coming years.
Okay. Mr. Arora, the one pocket that we have not discussed in detail is the IT space, which is going to be in focus because earnings will start this week itself. Where are you placed? How are you placed on the IT pack in the large caps versus the mid cap space? We've seen the mid cap IT firms really outperform. The large cap IT ones have moved up from their lows of March, April. At this point in time, where are you at? How are you positioned here?
So, meaning since we are a little bit worried about the global, economic situation, largely US and Europe, it's difficult to get, overly bullish on IT. And as you rightly pointed out, that they have already come off the lows that we saw a few months back. So I would say that they are into a range bound space right now. We need to get more clarity on the demand side before a sustainable rally can really build in IT. For me, it looks that it will be difficult. It's kind of a lower growth for slightly longer that IT sector really faces. So let's hope what kind of commentary really comes out from the Q2 results. If there are some signs of new deal wins, I think probably this sector can re-rate. But base case, I would say that it is going to remain range bound for some time now.
And perhaps that's the reason why leading companies like TCS, which are sitting on mountains and mountains of cash, are announcing buybacks to provide some kind of relief to long-term shareholders. The more you buy back, the lesser equity remains in the market, and that's definitely beneficial for really long-term shareholders. It's very easy for TCS. It's their fourth buyback in that many years, and ditto for Infosys and Wipro. So that's how large cap IT is trying to create wealth for its long-term shareholders. Of course, mid-cap IT is off the charts. Rakeshji, staying with this theme, what do you think is happening in mid-cap IT? They say they face the same constraints in terms of hiring manpower, paying a bigger salary to wean people away from TCS, from Infosys, from SAP, and the top global multinationals in the IT space that are there. Yet their stocks are running as if there's no tomorrow. Valuations, if you look at 70 PE, 80 PE, 12 to 15 times book value. What exactly is driving this change?
So, see, smaller companies have a low base and they can still grow if they get one-off orders here and there. And that is what is getting reflected, because if you are as big as TCS or Infosys, you are like, a big portion of the system. And if the system is not growing, it is difficult for you to grow. But when you are a small player, probably you can land up with one or two orders and you do okay. So I think that is what is really playing out. But see, this kind of outperformance is difficult to sustain if the broader, demand outlook is not that great. So I think, as I was mentioning, that I don't really see too much of an upside for this sector in the near term.
Okay. Let me ask you one more question that we've got from our viewers, Lisa. And that is again, from New Delhi, Puneet Rawat wants to know this. What is better in the long-term investment option? Blue chip companies, large caps, or should one just choose mutual funds route?
See, I would say that mutual fund route is better suited for retail investors because mutual funds can, they invest so much into research. They have access to all the broker research, and they are able to make much more informed decision on portfolio construction than an individual investor can do it. And the second thing which works for them is that you pay taxes only when you sell mutual fund. When the mutual fund sells stocks and buys new stock, you don't really have to face any taxation. Whereas the individual, if you switch between stocks, there would be, you'll have to pay taxes. So it makes sense that, retail investors stick to mutual fund rather than, trying to buy stocks themselves unless they are, truly knowledgeable about the sector and they are investing a lot of time trying to research the companies.
Rakeshji, a sector that almost all of us have forgotten, yet it is something very close to your heart, is the cement space. We've seen one very, very large transaction happening about 18 months ago, which was from the Adani side. And that's resulted in two marquee names, which is Ambuja and ACC, moving to their corporate umbrella. Apart from how mergers and acquisitions are panning out, what do you like in the cement space? Is this one of the growth opportunities that we have, given the kind of infrastructural push that is happening both from the government side as well as corporate India?
So demand growth currently is at 10% plus, which is very strong and largely driven by the infrastructure space. And housing sector is also doing reasonably well after almost one decade. Tells you that there's a strong demand from housing sector also. And a large company like Ultratech, which has been growing so fast, is operating at 90% plus capacity utilization. So that tells you that whatever is being made, despite all the growth that we are seeing, is getting sold. And now that is getting reflected into higher cement prices. Cement companies have been announcing, price hikes. We have seen large hikes getting absorbed in the Eastern India market. And now we are starting to see, smaller hikes getting absorbed in the rest of India. So this sector is looking attractive because one, cement prices are going up. Second, demand is extremely strong. And number three is that costs have moderated, but now they are starting to stabilize at these levels. So overall, cement sector looks very attractive.
Okay. Cement looks attractive. Since we're talking about also that we are just at the starting point of the earnings season, which top 2 or 3 sectors would you be betting on in terms of outperformance there where you expect, and where would you see underperformance coming in from?
So, see, I would think that the largest contributor to profit growth in Q2 is going to be oil and gas, because we saw oil prices dip and there would be marketing gains which oil marketing companies would be making in this quarter. Government had allowed them to make higher than normal marketing gains. Banks, I was mentioning, there will be a NIM compression. Cement sector should do well. Metal sector would be kind of slightly improvement QOQ. So I would say that overall, excluding oil and gas, probably we are looking at 15-16% growth for the Nifty companies in Q2.
Okay. So, talking about the oil prices, you know, there's one question that I missed from our viewers list, and that is from Noida. Riya Tiwari wants to know from you, how much importance should a retail investor really give to the fluctuations that we see in crude oil prices and US dollar yields? Does it really matter in their long-term vision?
The long-term vision, it doesn't really matter much, because in the long term, if something is going to impact everybody in the world, then it doesn't really, matter much, because then it will be passed on. So from a retail investor point of view, you don't really need to burn midnight oil worrying about US interest rates, etc. What you need to worry about is whether the company you're investing in has a competitive edge, has a proper strong balance sheet, and is able to support growth. So that's all you need to worry about. These macro factors resolve on their own, with time.
In the long run, Sakshi, all of us are dead, so it really doesn't matter. But reading too much of macro sort of is detrimental to the health of your portfolio, as also how you take picks. There was this one very interesting person who met me, and he said, जितनी गहरी आपकी सोच है, उतना कमज़ोर आपका डिसीजन मेकिंग हो जाएगा. तो कम से कम पढ़िए और अच्छी चीज़ पढ़िए. उससे क्या होता है कि दिमाग भी साफ रहता है और स्टॉक पिकिंग भी बढ़िया रहती है. राकेश जी, वन सेक्टर दैट probably is coming back on the radar for many long-term investors and stock pickers such as you is the API space within the pharmaceutical industry. A lot of buzz happening on paracetamol makers, a lot of buzz happening on blue chip stocks that are in the API space. They've come back very sharply over the last 6-8 months. Some of them are also part of the Nifty. How do you see this space? Is this time to step up on the buying plate, or this is again a flash in the pan that we often see in prices which are related to the Chinese geography?
So I think there's a normalization which is underway right now. Meaning during COVID, we saw that there were shortages of raw material because China was shut, and then we saw excesses built up in inventory because as companies loaded up, and the COVID reopening, post-COVID reopening in China didn't really lead to any kind of those infections which people were expecting. So now inventory is normalized, raw material supplies have been, supply chain systems are better. And so the margins are returning to API companies, and demand is, reasonably okay. So some of these stocks which were underperforming for quite some time are now starting to find their feet. So I wouldn't say there's a big rally which is happening, but it is a normalization. And so they're going back to normal margins, normal earnings.
Okay. Rakesh ji, with that, the time for the show draws to a close. It's been such a pleasure listening to your views and also asking you a question on behalf of our viewers. We only hope that you make your appearances a little more regular on BTTV. People learn a lot from genuine advice as well as great stock picking from individuals such as yours. Thank you for sparing your time for us.
Thank you so much. Thank you. Okay.
Thank you, sir.
So that was Mr. Rakesh Arora. He's the managing partner for a research house, Go India Advisors, which over the last 7 years helps under-researched and undervalued small caps and mid caps find their true potential. Thank you for joining us. Both Sakshi and I are very grateful for the time that you spent listening to Market Masters. We'll take leave as of now, but for the moment, remain with BTTV to find the best that there is in terms of financial news and ideas in the market.